Buenos días. Bueno, antes que nada quería agradecer su presencia y realmente estamos muy contentos de tenerlos acá en el Congreso Anual de la Asociación Peruana de Economía 2015, que es organizado, como ustedes saben, por la Asociación Peruana de Economía, la Universidad del Pacífico, la Facultad de Economía de la Universidad del Pacífico y la Superintendencia de Banca y Seguros y AFPs. Para nosotros es grato el desarrollar estos eventos, dado que, como ustedes saben, en la universidad tenemos las misiones de enseñanza, de investigación y de extensión. Y en el caso de la investigación, en la Universidad del Pacífico desarrollamos un esfuerzo para concentrarnos a través de nuestras unidades de la facultad, en este caso en particular de Economía, pero también a través del Centro de Investigación en lo que se refiere a investigaciones principalmente en las áreas de Economía y Negocios. Creemos que este tipo de eventos nos permiten promover y desarrollar estos espacios para conocer un poco más sobre temas económicos aplicados a nuestra realidad. Y realmente esperamos que estos 2 días que vamos a tener la oportunidad de escuchar una serie de propuestas e investigaciones nos permitirán conocer más nuestra realidad y sobre todo motivar el desarrollo de investigaciones con la participación de economistas seniors y también de economistas que están entrando a determinadas áreas de investigación. Esperamos, como he mencionado, que este sea no solamente un evento que termine en estos 2 días, sino nos permita continuar las investigaciones para conocer mejor nuestra realidad y tomar mejores decisiones. Muchas gracias.
A continuación, invitamos al señor Norman Loaiza, presidente de la Asociación Peruana de Economía, a dar unas breves palabras.
Buenos días y bienvenidos al segundo Congreso Anual de la Asociación Peruana de Economía. En primer lugar, quisiera hacer algunos agradecimientos a la Universidad del Pacífico, representada aquí por su vicerrector, el doctor David Mayorga, por esta magnífica infraestructura, por el apoyo intelectual y logístico que nos han brindado para hacer exitosa esta conferencia. Gracias al comité organizador, infatigable, liderado por Gustavo Yamada, conformado por Roberto Urrunaga, Pablo Lavado, Marco Ortiz, César Carrera y Nelson Ramírez. Y por supuesto, quiero dar gracias a todos los participantes, jóvenes, mayores, que van a ilustrarnos, contribuir con sus participaciones, con sus preguntas, con su atención al éxito de este evento. Quisiera referirme brevemente a la Asociación Peruana de Economía. Fue fundada hace aproximadamente 1 año y medio por un grupo de doctores de economía, alrededor de 120 personas, con el objetivo de promover la investigación académica de la economía y con el objetivo de contribuir a la cultura económica del país en general, con la esperanza de que estas dos, la investigación y la cultura económica, nos lleven a una prosperidad mayor de la población en general. Hace pocos días lanzamos un llamado abierto, una convocatoria a unirse a la asociación. Ya 120 personas se han inscrito y seguramente después de concluida esta conferencia el número de personas se duplicará, triplicará, ojalá, eso esperamos. Estamos inaugurando muchas cosas en la asociación. Una de ellas es nuestro logotipo, que pueden ver ustedes aquí, está al medio de la universidad y la superintendencia. Se estarán preguntando ustedes qué significan estos 2 hexágonos. Y como buena poesía puede tener varios significados y cada uno de ustedes puede tener el suyo. Para mí lo que significa es crecimiento, es decir, de algo pequeño a algo mayor, y para que ese crecimiento se dé es necesario estar asociado, estar enlazado. Esos son los 2 hexágonos que crecen y que se enlazan. La conferencia anual es el evento central de la asociación. Y más que un congreso, es un festival para nosotros. Es un festival, digamos, como mistura, es para la cocina peruana. Así queremos que sea una celebración de lo que se hace en economía, de lo nuevo, de las fusiones que hay entre distintas disciplinas, sociología, economía, entre las nuevas contribuciones a la macro, a la micro, y que después de cada sesión salgamos como al haber ido a un magnífico restaurante, contentos, satisfechos, alegres, quizás con nuevas ideas para hacer nosotros nuestras propias creaciones. Y esa es, en realidad, la aspiración que tenemos nosotros en la asociación, que el Perú sea conocido no solamente por su cocina y por Machu Picchu, sino además por su buena economía y por sus buenos economistas. Muchas gracias.
Buenas tardes. Invitamos a subir al estrado al señor César Carrera, doctor en Economía, quien va a moderar esta plenaria magistral en Macroeconomía a cargo del profesor Bental.
Buenas tardes con todos. En la mañana tuvimos la presentación de Norman Loaiza abriendo esta conferencia. Ahora el honor es mío presentar a Benjamin Bental, profesor en Economía de la Universidad de Haifa. Él es doctor de la Universidad de Minnesota. Tiene múltiples publicaciones. Dentro de las últimas conferencias que lo he escuchado hablar está toda esta historia de QE, ¿no?, y los efectos que tiene a nivel internacional. Ahora nos va a hablar de una cosa algo diferente y mucho más actual y vibrante acerca de la crisis en Europa, ¿no? Tienes un punto muy particular, es muy recomendable. Les garantizo, van a salir tesis después de esta presentación. Muchas gracias.
It's my third time in Peru, so that means I like to be here, and again, that gave me a wonderful opportunity to come back and visit. And now I'm going to give you a presentation which is totally non-technical. There will not be a single equation in this presentation, nor a single regression. So it will be very informal, as I've said. I was asked before the previous session by some people from the Pacifica why I'm giving a talk about Europe, basically, right? And I was a little bit stunned by this kind of question, I must admit, because I thought that it was sort of self-evident, but maybe it's not. So I should emphasize the importance of Europe for the rest of the world if it is not clear enough. So we are talking about the European Union as a, one entity. This is probably now the second largest, maybe the third largest economy in the world, right? It's always a contest with China. So we are talking about a huge economic bloc. And of course, a very large population exceeding that of the United States. So it's an important, entity in the world. And of course, when this particular entity is sick, then, as has been said in other contexts, the rest of the world gets influenza. So there is an issue of spillover, and that probably also affecting Peru in some way. Of course, I don't know, because I'm not an expert on Peruvian economy at all. The other aspect that I want to really emphasize, and you'll see that again and again in this short presentation, is that Europe presents a wonderful example to the rest of the world. I mean, it was not that way, of course, in the past. So we are talking about a Europe that has been at war for centuries, and of course was the source of two major world wars. The last one cost the lives of 60 million people. So this is a tremendous, of course, cost that has been imposed by, especially Germany, on the rest of the world. And now you have Europe at peace. And this is, again, I mean, for those of you who have been to Europe, you have seen it. essentially, and I can, you see with my gray hair that I've been around for a while, and I can remember Europe at peace, but still with borders, right? So you would stop at border lines and you would be checked. And now none of that exists. You simply cross from one country to the other as though you cross from San Isidro to Miraflores, and that's it, right? And this is really, really amazing. Let me just, before I start talking seriously, one more episode. I have a very good friend who is actually a result of that World War, because his mother is German and his father is French. So a result of the French occupation of southern Germany. So he impersonates this dual personality, which, if you think historically, was almost unthinkable because of these two nations' animosity. And we were driving along the Rhine on the French side, and there was a German military column, sort of going on the French side of the Rhine, and as though nothing, as though it was in Germany or anywhere else. And of course, he commented, had that been the case maybe 60 years ago or 70 years ago, that would have been, of course, or 80 years ago, that would mean war, right? So if a German column moves on the French side, but now it is day-to-day event, nobody even winks at that. And this is really remarkable. And this is the background against which I would like you also to think about the European crisis. So I'll start by giving you indeed some historical background. And because of the importance of this issue, and once you understand this historical background, you also basically understand that no matter what happens in Europe, and I have to be careful about making predictions, but this is my feeling. No matter what the economic cost of whatever event takes place right now, for example, Greece, the European community or the European Union will invest anything it takes in order to stay intact and keep the peace. So that's what my claim is, right? We are talking about politics, really. Economics is important, but it is in some sense a sideshow to this entire business that is called the European project. Okay. So where did it start? Well, we were talking about World War II in particular, and the French historical fear of a major German neighbor. And the idea was to sort of check this German neighbor within some kind of an international arrangement. And this is where it all started, right? So we're talking about 1950, as you see here, and it was a French initiative, and this is important to understand also today, right? When we think about Greece, for example, the role of France vis-à-vis Germany. And it was the idea of Robert Schuman to sort of start some kind of an organization, the European Coal and Steel Community, and the idea was to simply, as you see here, and that is extremely important, right? Make war not only unthinkable, but materially impossible, right? So the idea was to simply safeguard peace by incorporating Germany with its huge industrial capacity, indeed at that point in time destroyed, but with a huge potential, in particular, right, with huge coal reserves, very, very strong steel industry, to inside this European binding organization so that they will not be able to rearm just like that again. Okay, then this thing has developed, but I want to again come to this notion that we are talking about a project of peace and war. And these quotes here that I'm going to show you are coming from the heat or the height of this crisis in 2012. And now we have a major actor in this particular venture called Europe, namely Helmut Kohl. And, with these kinds of words, right? So again, let me read it because it is so important. The evil spirits of the past have by no means disappeared, right? So we're talking about 2012. And can return again and again. That is to say, Europe remains a question of war and peace. And hence, the peace principle is the underlying motivating rule of European integration. So again, we're talking about war and peace, right? It's amazing as it sounds that this is the way a major European leader is thinking, or was thinking, about the European crisis. Now, there is more of it. I'll skip it over because of I want to get to the point, and just very briefly and very quickly give you again the history of the build-up of the current, or how we came to the current structure of the European Union, in particular of the European Monetary Union. So again, the starting point was this steel and coal community. Then out of that emerged the common market, and the common market then became the European Economic Community. And then, again, I'll skip over that very quickly. This particular body has encompassed more and more countries, right, starting with the original 6 countries that were party to the European Steel and Coal Community, and then expanding into the E12, and you see, right, including at that stage also Greece. Right, this is an enfant terrible, which we are going to talk about a little bit later on. And then towards the establishment of the monetary union, this is of course where I want to come, we have 2 joiners, Austria and Finland, in 1995. So that was the core of the European Union, or the European Community at that point in time, when indeed the monetary union was conceived. So again, and not accidentally, we are talking about a French person who was behind this particular initiative, right? Because of the same idea, let's contain Germany. And containing Germany means let's have Germany in as many international sort of supranational organizations as possible. So, of course, the monetary union that involves giving up sovereignty. This is what we see with Greece now, right, in a big way. And this is what the French foreign policy tries to do all along. Okay, so again, this is a political kind of venture that we're talking about. Okay, so let's talk about now a little bit of economics. So we are talking about a monetary union, in other words, establishment of a common currency for the member states of that projected union. And now you see what this is involving. I won't get into all of these stages, so these were the 3 initial stages. This is a little bit hard to read, so I'll simply point out the main point. So once the agreement has been made among the potential participants, there will be, at that point in time, right, 3 stages leading towards this integration. And at stage 2, and as of stage 2, and mind you, this is of course very important to understand what is going on now, there will be a ban on central banks granting credit to the public sector. So you may wonder that this at all appears here, right? Because I think this is something that, when you think about modern central banking is so self-evident, but it wasn't. In France, for example, the central bank was a branch of the Ministry of the Treasury. Of course, therefore, was not independent, right? So it was easy for the French government to come to the central bank and say, give us a loan. And right, that was okay. That was perfectly within the Constitution. So here is something that, of course, is reflecting the German way of thinking, right? So the French initiative, but with a lot of German influence, saying, no, central banks are central banks. They are totally independent and certainly are not going to give any loans to the public sector. And this is something we need to remember, again, coming to today, because one of the big issues concerning the ECB is precisely that one, right? Where is the ECB relative to the countries that are in trouble, and to what extent is the ECB allowed to directly help them, right? So this is saying, no, it's not allowed to do that. And then we have, in the last phase, when indeed this European Monetary Union comes into effect, we have something that is called the Stability and Growth Pact that is still governing what is going on today in Europe. But once more, let me backstep just a second in order to again talk about the political background. And we are talking about the days of the demise of the Soviet Union and the reunification of Germany, right? So, of course, again, the reunification of Germany created great tensions in Europe. A lot of people didn't like the idea that Germany gets reunited, in particular, of course, in France, also in Italy, also in other countries. But these two major partners of Germany are, of course, important. And here you are, right? So you have a reunified Germany, potentially with a lot of power, in the middle of Europe, right? Again, the source of 2 world wars. And now something needs to be done in order to check that power, right? And again, this is where Delors came with his initiative concerning the euro. Okay. We come to the Maastricht Treaty. This is, of course, crucial, right? The Maastricht Treaty was a treaty that is underlying the European Monetary Union, and here are its principles. Okay, so what do we need to do to be in order to be able to join the European Union, the European Monetary Union, the Eurozone? So number one, you should not have a high inflation, certainly not exceeding, again, as you see here, by 1.5%, the level of the average of the lowest inflation countries. Right? So again, think about what is going on. The French try to create this particular supranational structure, but the Germans sort of govern the rules. The Germans, for historical reasons, are extremely averse to inflation. And they say no inflation, basically, right? I mean, we are a low inflation country. We want all of those who join this particular European Monetary Union to be low inflation countries. So this is number one. Number two, government deficit should not exceed 3% of GDP, right? We are going to see shortly to what extent all of these nice rules were followed. Number three, national debt shall not exceed 60% of GDP, right? So again, why 60%? Well, I mean, this is sort of a rule of thumb. You can sort of think about what happens if you have a constant debt to GDP ratio of 60%. Let's take, I don't know, a interest rate on I take it high, let's say about 3% real in the long run. So you are talking about 1.8% of GDP. And growth rate on average in these countries is, roughly speaking, 2% per year. So this is sustainable, let's put it this way, right? So this is where this number came from, not that there is a big theory behind this. And so on. Okay, so these are the joining criteria. And now we come to the famous Stability and Growth Pact that has been supplementing the Maastricht Agreement and has been or is applicable to all European Union countries, not only to the Eurozone. Okay, so this is, of course, the point. And this is where Germany came in and said, fine, you want us encompassed within a supranational organization? Fine, then play by our rules, right? So this is sort of the deal that was struck there. And you see now what they require is that not only upon being admitted to this club, you are supposed to have a 3% deficit and no more than that, and 60% debt to GDP ratio, but you are supposed to maintain it forever. And the regime then that is going to be imposed is involving some kind of a oversight mechanism through this so-called Council of Ministers, which is a body that consists of representatives of ministries in European countries and is supposed to be oversighting this particular arrangement. Moreover, if you're violating, then you're going to be punished. Right? So this is a fine that is going to be imposed on you if you're violating these rules. And moreover, explicitly, the SGP says there shall be no bailout of a country in trouble. Okay, so we are talking now about the late 1990s, and this was sort of the vision, right? We are creating this monetary union, and we are going to impose discipline. You know, thinking in terms of game theory, you can understand what is going on. The question, of course, is whether this is subgame perfect. I mean, as we know, it is not, right? So you simply say, we're not going to bail anyone out. And of course, if you believe that this is indeed going to happen, then any given country which is a member of this club shall behave properly, because it knows that it will not be bailed out, right? So this is supposedly an equilibrium. Again, that was the idea. So this is very important to bear in mind, that this clause is still there right now, right? I mean, all of these agreements are still in force. So this is sort of the setup that we are talking about. Okay. And there is nothing there about, again, a possibility of a country leaving either the monetary union, right, the Eurozone, or more broadly, the European Union itself, right? So simply there's no word about it. And I'm going to maybe talk very briefly about the United States, probably not a lot. But as you know, the United States is also a monetary union, right? I mean, a very strong one. And the notion there is that states cannot secede, right? They simply cannot. So if a state says, like let's say California says, well, we want to go our own way, they'll have the federal army in no time, right? I mean, in Sacramento taking over the country. The only state that claims that it can secede because the way it has acceded the union is Texas, right? The Lone Star State. They say, no, we are not bound by it. We can secede at any moment in time. Let's see what happens if they try. But in Europe, as I say, right, I mean, the situation is totally different, right? It's not the same kind of federation as in the United States. There is no central government. Nevertheless, right, these agreements simply don't talk about the possibility that anyone may leave this particular union. Okay, so here is the expansion. Again, I'll skip it over, but I want to show this slide. This is important. So this is a slide which was, I copied it from the New York Times, and this is in real time, right? So this is before if I see correctly, it is in 1998, so it was before before the euro was printed, right? I mean, it is when the agreement has been already made, but before it has been realized. Okay, so you see these famous criteria, right? And on the horizontal axis, you have the public debt as a percent of GDP. On the vertical axis, you have inflation. And here's the 3% mark, and here is the 60% mark, right? So that box here shows you the countries that were satisfying the criteria, right? So there is a bunch of them. Then you have a box here that is satisfying the inflation criterion, but is not satisfying or was not satisfying the debt to GDP criterion, even then. So you see Italy there, right, in particular. There are others as well, but Italy, right? And we'll talk about Ireland in a second. And here you have, of course, the outlier on both of these criteria, which is Greece. But Greece at that point in time was not even a potential member of that bloc. So what happened with Greece? Now, Greece was allowed to join nevertheless, right? I mean, that despite this particular figure that was known to everyone, right? This is New York Times, this is not a secret service. Everyone can read it, right? So everyone knew this particular picture. Nevertheless, Greece is admitted in 2001, right? So very shortly after this bloc has been formed. And why this has happened is not very clear to me. It seems to be that France was again behind the scenes, right? So the French have already caused Germany to agree to Italy's inclusion in that bloc, despite its high debt to GDP ratio. But with Greece, probably the same, right? So one more finger in this particular bloc to sort of balance Germany. Then, in order to sort of satisfy, at least on paper, the criteria, there was a lot of cooking going on, right? And Goldman Sachs was involved in that in particular, with a lot of machinations, very creative kind of accounting, sort of bringing the numbers into the right zone, right? But they were all false. And I believe that everyone believed that they were all false. But nevertheless, right, this is what happened. Okay, so just to give you some idea about this particular club now, we are talking now about the Eurozone, right? I'm not talking about the European Union countries that are not members of the Eurozone. You can see basically the distribution, right? So this distribution looks like a, sort of a Pareto distribution, right? There is a huge, very long, very thin tail here of all of these tiny countries, right? So this is, again, the share of GDP of each of these countries of this particular bloc. In Germany, roughly speaking, is 30%, right? You can think about a third, right, roughly speaking. Again, you have France, and you have Italy and Spain, and with that, actually, the story is over, right? Then you start collecting a bunch of small countries, and in particular, when you see here Greece, which is, 2% of the entire GDP in this particular bloc, right? So this is a very, very small contributor. So this is sort of in order to give you the idea of who the major players are and all the rest, right, which are really, really tiny, relatively speaking. So let's talk for a second about theory, right? I mean, just after all, this is a conference in economics, and I need to pay my dues also to that. So there is this concept that is called the optimal currency area, which has been coined, I think, by Mandel, as you see here in the 1960s, early 1960s. And here are sort of the theoretical backbone that Mandel was talking about for the creation of an optimal currency area. Okay, so number one, labor is supposed to be mobile within that particular currency area. Number two, of course, all markets should be competitive. Okay. Then there should be, and this is important, there should be an inter-regional transfer system. And for obvious reasons, right? In order to balance out temporary imbalances. So that is really important, right? And then there is this particular point, namely that business cycles should be well coordinated within the currency area, because otherwise you can't have a policy, a monetary policy that will fit all of these regions, right? Once you have one currency, you cannot then say, oh, I conducted, a monetary policy that is applicable to Ancash but not to Lima. That is impossible, right? It's the same currency. So obviously this is an issue, yeah? So these business cycles have to be sort of coordinated. Now, when we talk about Europe as an optimal currency area, according to these particular criteria, then of course you basically get a fail on every one of them, right? So this is quite astonishing as a matter of fact. So labor mobility on paper, sure, right? I mean, if you hold a European if you are a holder of a passport of a European Union member, you can work everywhere in the Union. There was a little bit of reservations or restrictions on new joiners from Eastern Europe, but those are also basically over, right? So there is, on paper, free mobility, but of course, unlike the United States, these countries are using, 20-some different languages, right? So this is a huge problem. So in particular, people talking about young Spaniards who are unemployed moving to Germany. Of course, this is fine, except that they'll have to learn German, which is not easy. So, right, so this is a problem. Then, of course, since these countries are perfectly sovereign, They all have their own labor laws, right? So the labor laws are not harmonized, and so on, right? So the labor mobility is there on paper. It is okay for university professors, right? That's perfectly fine. But other than that, very, very, very little of it. So again, efficient markets is a problem because, again, unharmonized regulations, unharmonized taxes, etc. Transfer system doesn't exist, right? So again, we are coming to the Stability and Growth Pact, which prohibits bailouts, as we have said, right? So we are not allowed to do that. There is no fiscal union. The Germans wanted it initially. The French blocked it. And so there is no fiscal union. And therefore, there is no European tax system like the federal tax system in the United States, and therefore there are no automatic stabilizers in place, right? So all of that is totally missing. Again, unemployment insurance is a state business, I mean, member state business, not that of the union. If you think about this, the entire operation run by some kind of form of a government, nevertheless, that particular government, in other words, the bureaucracy is a bunch of coordination actions, and they have this parliament and all of that, and nice scientific programs from which some of us live very well. But other than that, right, they cannot conduct any fiscal policy to be, which is worth talking about. Now, the business cycle issues, of course, also, they are very uncoordinated, but again, if you think about the United States, this is also sort of the case there, right? I mean, the US also, in this particular point, is not terribly coordinated. The South and the North are not very coordinated, the West and the East, etc. But, of course, this is compensated for by the transfer system that is in place in the United States, and of course by the stabilizers that are in place in the United States through the federal tax system. Okay, now, 1:15, right? So, 10 minutes. I'll make it very short. So I'll pass on this particular digression. I just want to maybe, very briefly bring up the question, right? I mean, the United States, as I said, is a monetary union, a very, very important, very stable one. And you wonder why, there is no dollar crisis in the sense that we're talking about the euro crisis, let's say right now, right? Despite the fact that we have a huge federal government deficit, right? It reached really a trough of 12% here. Then it was improving a little bit. The debt to GDP ratio far exceeds the famous 60% of Maastricht. And the states are, of course, in debt. I mean, they are not as badly, or were in debt. The debt rate, their debt has been going down in recent years. But I show you at the peak of this crisis in Europe, parallel to that, there were crises in several US states. And nevertheless, probably none of you has heard about it. Most people don't even know that Michigan was sort of close to a breakdown, and California was close to a breakdown. Now, of course, there is Puerto Rico, but this is tiny, right? It is in a breakdown. And nevertheless, world markets don't react to these kind of things at all, right? And it comes back to this very different structure of the United States as a monetary union relative to the European Union, right, as a monetary union, lacking any fiscal background that enables it to really function in a reasonable way. Okay, so let's talk a little bit about the dynamics of the European crisis, just in order to have some kind of an idea. And here you have the famous 3% deficit, right, which according to the SGP has to be maintained forever. And you see what this forever meant, right? So, so in particular, because here you have a very bad situation with Ireland, but Ireland is a sort of an outlier. But let's look at the other countries here, right? I mean, and you see Spain here in this purple, and you see Portugal here, I think, right, with this brighter to purple. And mind you, and this struck me really, right? When I collected the data to prepare this particular lecture, I went to the Eurostat, which is the official European Union Statistical Bureau. They don't report Greece before 2011. Right? So that means, of course, that whatever numbers you find, and you can find them elsewhere in the OECD or the United, some kind of US sources and so on, these numbers are totally unreliable. So they simply don't report anything about Greece prior to that. Right? So that you can put here anything you have, you imagine. But you see, when these numbers became officially verified, we're talking about 10%, right? I mean, then little by little Greece has indeed improved. Okay, so 60% debt to GDP story, right? I mean, you see this. Again, you see Greece up here, right? I mean, these numbers don't exist before, right? And this is something which is really quite high, right? Roughly speaking, 180% or something like that. So these are huge debts, and of course, if you think, if you take Italy, I mentioned Italy, right, which was violating the rules from the beginning, and having been admitted because the French wanted to have them in. Okay, so this is essentially, again, the politics that played a role here, and not anything else. Sanctions were not, so I told you, right, I mean, that violating countries were supposed to be sort of put before this European Commission and sanctioned. They were supposed to be paying 0.5% of GDP for violation. Now, the first country that violated was Germany. So you can imagine what fine it was paying, right? I mean, obviously 0. And that was not the only case. As you see here, I mean, all of these countries are violating 0 sanctions. So this mechanism is not in place. Right? So in other words, you write a contract which is meaningless, right, because it is simply a contract among sovereign countries. Again, there is no central government, and it is not imposed and not acted upon. Okay, this picture is the most striking picture that, at least I think, I have seen in my career as an economist. I'm really serious about that. And the first time I saw it, I was totally amazed, and whenever I see it again, I'm amazed. Okay, so what is it? So you have here a 10-year maturity rate on national debt, national bonds, of the various countries. I mean, I only have these, right? These are the interesting countries from the point of view. So again, Germany always this dark blue as the basis of everything. Okay, here is where the union comes into effect. And you see that all of these rates converge, right? So this is okay, because that was the idea of preparing these countries towards this unification, right? So they all meet the Maastricht criteria, let's say, and the market reacts by simply saying Italy and Ireland is rightfully so, but Greece, which is hidden here, right? You don't see anything here because all of these curves lie on top of one another. All of them, all of these guys here are all moving together, and they're moving exactly like Germany. So there is no difference in the eyes of the market between the national debt of Greece, the national debt of Italy, the national debt of Spain, right? All of these guys, the national debt of Portugal, and the national debt of Germany. All of them are priced in the same way. No risk premium whatsoever. This is, you know, as I say, as an economist, when I see that, I sort of say, well, you know, I raise my white flag. If the market has taken this kind of story as seriously as this figure shows, that means that markets, you know, you cannot defend market efficiency in any way that you can, right? That you can imagine. This is really, really amazing, this picture. Then comes Lehman Brothers, right? So this big shock, and suddenly the market wakes up and says, wait a second, Greece seems not to be Germany, right? And here you have it, right? So and Germany, of course, now you start seeing these curves separating from one another, and they are priced according to country risk, right? I mean, and the issue is, of course, what do we mean by country risk? And this is a huge issue when you are in a monetary union. And when you are in a monetary union, as we said, right, that has one central bank that is conducting monetary policy and no bailout clauses, etc., right? So the market says something here is fishy. We don't know how this is going to function. In particular, again, let's take Greece as the example here, right? But of course, also the others. Ireland is a different story. I won't go into it. But of course, you see Ireland converge very nicely. You see the others converge very nicely toward Germany. You see, of course, Greece not converging at all, right? So there is the ups and downs. But the market is certainly still seeing huge risk factor, right? This stuff is up to date, right? So this is basically now. So as I say, it is an amazing picture, right? And we should all take a lesson out of that one when we talk about how well we can rely on markets to tell us what is going on. Okay, I should conclude, basically. So I'll jump over all of that and not talk about all of these points. Maybe one point I want to make, of course, there is a huge problem of trade imbalance within this bloc, right? I'm talking now about the Eurozone. And you see here Germany with a huge trade deficit, surplus, of course, and here you have the other guys with appropriate deficit, especially, and essentially, if you look at the internal accounts, they are shown here. So this is only intra-Eurozone trade, and you see what is going on, right? So here is Germany with these surpluses. These are German claims on the ECB, and which are, of course, positive, and they're financing all of these negative guys, and when you sum them up, basically they sum up to zero, right? So Germany is financing the trade deficits of all these other guys. And of course, I mean, in this sense, the question is that sustainable, right? I mean, and it wasn't like that before, as you see, right? And all this wonderful period prior to the demise of Lehman Brothers. Okay, resolution, again, very, very briefly. There are, of course, internal steps that the weak countries are supposed to undertake and are undertaking. You see here what we call internal devaluation. In other words, what happens to unit labor costs because of all kinds of policies in the labor market. And you see in particular Ireland, right? I mean, dropping very quickly, and it is now below Germany. But you see also the others, right? I mean, here is Greece with, after all, tremendous steps that have been undertaken under pressure in order to reduce labor costs and make Greece more competitive. Of course, this comes at enormous price, human price, right? I mean, here you have it by way of unemployment, right? So the unemployment in these countries that are really suffering under this pressure is really excessively high. And of course, again, the question is to what extent is that kind of sustainable? And you need, after all, right, the support of these people when they go to the ballots and vote for or against Europe. And this is something that the European community or the European Union has to certainly want to worry about. Okay, so then there are external measures, as I call them, right? And this is a nice cartoon that appeared in, I think, I forget where. I didn't write it down, unfortunately. I think it was some Irish newspaper. And it talks, I don't need to explain it. And of course, so there is a lot of the discipline, right? I mean, so Germany is imposing these clauses that I have been talking about before, more and more strictly on the partners, as of course now the Greek story is just a case in point, where basically the Greek government, after a very weird period where they tried all kinds of tricks, has succumbed totally to German demands, right? I mean, European demands, but these were really German demands to pass all these reforms. Whether they are really going to enact them is a different story, but they have passed the parliament, right? So this is certainly part of that story here, right, with this whip. Okay. And then there is also a lot of financial support, right? And again, lack of time, I won't go into that. I just want to talk about the ECB for a second. As I said, there is a problem with the mandate of the ECB, not a problem. I mean, this is a mandate that is reasonable when you think about the role of central banks, right? Again, it is prohibited from directly engaging with governments. So now you had this problem in the bond market, and of course, this is sort of a circle, right? That is very vicious. So if a country risk is rising, that means that that country has to pay higher interest on the world markets in order to raise capital, in order to pay its all debt, and of course, this is how debt is spiraling up. And the ECB was very concerned about that and trying to sort of downgrade country risk by directly intervening in secondary market, bond markets. And there was a lot of noise in Germany concerning this particular policy, claiming this is really a cheap trick, violating the basic mandate of the ECB. But it passed, right? I mean, this is the way it has been done, and Draghi has really reinforced that by saying, and really calm, the market took him seriously. Of course, now, after I showed you this particular picture, I'm not sure that taking the market seriously is serious, but the market did take seriously when Draghi said about a couple of years ago, we are going to do whatever it takes to save the euro, right? And they really are doing whatever it takes, so intervening very heavily in secondary markets, claiming that intervening in secondary markets is okay, because this is not direct support for member governments. Well, we understand that the distance is very, very short. Anyways, I'll skip over that. I'll just talk a little bit about that, and then we'll be done. So the question is restructuring of the European Union, in particular of the Eurozone, is all the time on the agenda. And here are a couple of things that have been discussed and until now have not been implemented because of political problems within this particular community. So one idea was to issue Eurobonds. So these were bonds sort of guaranteed by the entire community, or the entire union. The Germans, of course, objected vehemently, right? Because they said, oh, we are going to subsidize directly all these other countries through this particular guarantee. So no go, right? Then there are these ideas, more Keynesian ideas of having expansionary fiscal policies. Again, Germany is certainly not very, very enthusiastic about that, but again, within this particular deal of having peace in Europe, they may acquiesce if indeed they can impose on member countries fiscal discipline. Right, so that may come to, it's not yet there, right, but it may be implemented in the future. Banking union is something, again, the Germans are blocking at this stage because of the same reason, right, of mutualizing bank debts. And they say, why should we pay for, I don't know, the debts of the Spanish banks, etc. So this is not going to come at this stage. And now we come, of course, to this question of whether Greek will or will not stay in. Okay, and this is right now the hottest issue still in Europe. As we know, just about a month ago, right, they agreed to hold Greece in, subject to all of these conditions that I've already mentioned. And if you want to take my word for it, this is probably going to stay, but we don't know. Okay, so I'll finish with that. So again, here is a nice cartoon, this time a German cartoon, and it's right, we know these two figures, and this guy comes with a bill, and Hollande says, oh, this is for you, right? And so this is sort of the quintessence of the story. Just to give you some numbers, by now, if you talk about a transfer union, right, in effect, you have a transfer of, roughly speaking, 12,000 euro per person, cumulative, that has been received by Greece, paid for, roughly speaking, right, because Greece is 1/30 of the population, each Eurozone citizen paid about 400 euro for that particular exercise. So this is quite significant, right? I mean, we are talking about serious stuff. Okay, so as I said, well, I believe this particular project will survive, but I must end with this particular caveat, right? I mean, and all of you here are economists, so we should all sort of remember this idea that this is who we are, so we know perfectly well to explain why our predictions didn't come through in retrospect. But this is what I think will nevertheless be the case. And I'll stop here. Thank you very much.